Okay, let's just dive right into this. You know when Drake just casually drops a surprise collab out of nowhere? Zero promo, and the entire internet basically has a collective meltdown before 9 a.m. on a Monday? Well, that is exactly the energy of this weekend's fintech news cycle. I mean, while most of us were just doing whatever we normally do on a weekend, the absolute titans of global finance were completely redrawing the map. And the crazy part? They did it totally under the radar. So in today's explainer, we're going to show you exactly how it all went down.
So here's the absolute core of it. Stablecoins and modern financial infrastructure, they're having their iPhone moment right now. The underlying plumbing of global finance is going through this silent, rapid-fire revolution. We aren't just talking about, some minor iterative updates here. This is a fundamental, ground-up shift in how money actually moves around the planet. And over the weekend, the major pieces of that puzzle just locked right into place.
To unpack exactly how this is happening, we're going to break this down into three massive case studies today. First, Nubank's US speed play. Second, Meta's huge stablecoin comeback. And third, how Bakkt is building the pipes underneath it all.
All right, let's kick things off with Section 1, Nubank's US speed play, knocking on America's door.
For little context, Nubank is already the world's largest digital bank. They've got a staggering 114 million customers down in Latin America, and right now, they are prioritizing sheer, unadulterated speed to break into the US market. Normally, a bank walks through the front door, right? They wait for a pending OCC bank charter. It's a federal license, gives you total independence, but it takes forever. And growth-hungry fintechs? They do not want to just sit around twiddling their thumbs while US market share is out there for the taking. So Nubank is using the spare key. They're completely bypassing that huge wait by partnering with a sponsor bank so they can launch right now. Sure, transitioning customers off a sponsor bank and onto a new charter down the road is going to be messy. It'll be expensive, but the immediate advantage? They are market-ready today.
In fact, if you check out a disclosure from Nubank's own website from April 9, 2026, it spells it out perfectly. It says, "Nu is not a bank. Our services are offered in partnership with Lead Bank, member FDIC." So through Lead Bank out in Kansas City, Nubank is already offering the absolute core fintech stack. We're talking credit cards, debit cards, deposit accounts. They're delivering these fully functional banking products in the US without technically even being a bank themselves yet.
It's just a classic speed play playbook. By going the sponsor bank route, Nubank gets their actual product into customers' hands in a matter of months rather than years. And they're following right in the incredibly successful footsteps of giants. Think about Chime. They built a $2.2 billion revenue business by 2025 using this exact same method before going public. Or SoFi. They did the same thing and then successfully flipped to a full bank charter in 2022 and just watched their margins absolutely expand as a result. Nubank is running that exact same playbook, but they're doing it with a Brazilian accent and the incredible momentum of a 50% annualized revenue growth rate behind them.
So the big takeaway from our first case study is pretty simple. Nubank isn't waiting around for permission. It's already in the room. They've managed to pull off this super rare two-front offensive that most neobanks literally only dream of. They've got a conditional OCC approval in the bag for their long-term future, while at the exact same time having live US products capturing users today. It's brilliant.
Okay, moving right along to Section 2, Meta's stablecoin comeback, the platform push.
You guys remember 4 years ago when Meta ultimately killed off its highly anticipated Diem and Libra stablecoin projects? It was this massive regulatory avalanche. Well, guess what? They're back, but this time with a totally new approach. Instead of trying to build their own coin completely from scratch and fighting this brutal uphill battle against regulators, they're simply snapping together existing, proven puzzle pieces. So the asset? They're using Circle's USDC to pay content creators. The back-end plumbing? They're utilizing Stripe. The network rails? They're running on Solana and Polygon. And for the user interface, they're supporting major already existing wallets like MetaMask, Phantom, and Binance. They literally rolled this out on April 29th, directly embedding crypto into their creator monetization stack. They're starting with creators in Colombia and the Philippines, which makes sense because those are two emerging markets where crypto adoption is actively outpacing traditional banking infrastructure.
And we really need to talk about the scale of this because it is staggering. $77 billion. That is the colossal market cap of Circle's USDC, which makes it the second largest stablecoin in the entire world. Meta isn't taking on the enormous risk of launching an untested coin. No way. They're taking an existing, highly liquid giant and effectively turning it into a dedicated payment rail for their users.
And the stakes for treating an existing token as a payment rail? They are almost unbelievably high. Check out this number, $1.5 quadrillion. That's quadrillion with a Q.
That is the mind-bending projected stablecoin trading volume for 2035, according to Chainalysis. To reach a staggering number like that, you need exactly what Meta is doing right now. A massive, mainstream, consumer-facing tech giant normalizing crypto payouts the exact same way PayPal normalized digital wallets 20 years ago. So here is the absolutely crucial point. When a platform with 3 billion users starts paying out in stablecoins, the adoption curve bends permanently. This is no longer some niche underground experiment. And it's definitely worth noting that last year's Genius Act, which helped establish a legal framework for digital assets, really greased the legislative skids for this level of integration. That legislation paved the way, and now Meta is just confidently walking right through the front door, making stablecoin payouts feel as natural and normal as, getting a Venmo.
Which brings us to Section 3. Bakkt builds the pipes, the settlement infrastructure.
To really understand the pipes beneath all of this, we have to look at a major acquisition. On April 30th, Bakkt made a massive, strategic move by officially closing its acquisition of Distributed Technologies Research, or DTR for short. Let's break down exactly how this deal came together. It was structured as an all-stock deal, issuing 11.3 million Class A shares to DTR holders. By acquiring this Cyprus-based developer, Bakkt immediately gets its hands on an AI-native engine and an incredibly advanced compliance stack. Bakkt already had this heavily regulated institutional footprint and nationwide licensing, right? Well, now they're supercharging that entire foundation with DTR's next-generation technology. And this acquisition is just absolutely vital because it's all about creating what's called a digital settlement layer. Now, what does that actually mean in plain English? It means a 24/7 financial infrastructure designed specifically for programmable money. The big takeaway here is that this technology completely bypasses the slow, clunky, traditional correspondent banking system. Instead of waiting days for money to clear across international borders during strict business hours, these autonomous agentic payments, which are executed automatically by software, they settle instantly, securely, and around the clock.
So why is Bakkt going all in on building the settlement layer? Well, because of a $44 trillion opportunity. That is the massive size of the global cross-border payments market. Bakkt is aggressively targeting a slice of this enormous pie. They want to be the fast, digital, 24/7 superhighway that processes that $44 trillion of global movement.
As Bakkt CEO Akshay Naheta, who, by the way, originally founded DTR, as he puts it, this deal is the culmination of a single, cohesive strategy. We all know Bakkt has been in a bit of an identity crisis mode for a few years, right? Initially hyped, but really struggling to find its footing after the whole FTX collapse shook the entire industry. But this proves they've moved past that. They aren't just chasing the future anymore. They are actively building the stablecoin settlement backbone that major institutions and fintechs are going to seamlessly plug into without having to rebuild everything from scratch.
Okay, let's pull all of this together, because seeing the interconnected big picture is exactly what this explainer is all about. Literally over a single weekend, the future of finance just snapped right into place. The player? Nubank proved that massive neobanks aren't waiting around for the old rules. They're entering the US market instantly through the side door. The platform? Meta completely validated USDC payouts, turning a massive stablecoin into an everyday payment rail for billions of users. And the pipes? Bakkt secured the exact technology needed to build the 24/7 settlement layer sitting right underneath all of this activity.
Which leaves us with this final, absolutely crucial question. Are you still treating crypto like a phase, or are you ready for the new financial rails? Because as we've seen today, the infrastructure of the future is no longer theoretical, guys. It is already here, and the biggest players in the world are deploying it fast. If this breakdown helped you grasp the silent revolution happening in global finance, do your future self a massive favor. Subscribe to Fintech Stacks, follow the trades live on Robinhood Social, and definitely share this explainer with that one skeptic in your group chat. Thanks so much for joining me on this deep dive into the digital frontier, and keep learning.